Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing star bulk carrier stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Star Bulk Carriers is a shipping company focused on the transportation of dry bulk cargo. It owns 128 vessels with an aggregate capacity of 14.1 million DWTs. That stands for deadweight tons. They have 17 Newcastlemax, 22 Capesize, 2 Mini Capesize, 7 Post Panamax, 41 Kamsarmax, 2 Panamax, 20 Ultramax, and 17 Supramax. The smallest ship can carry 52,000 DWTs and the largest 210,000. The company transports iron ore, minerals, grain, bauxite, fertilizer, and steel products. The supply of ships in the market is highly correlated to the profitability of shipping companies. The cost to maintain a ship is fairly fixed depending on the age of the ship. The revenue each ship receives can vary a lot depending on the number of total ships in the entire market. There will always be demand by companies looking to transport dry cargo across the ocean. To transport dry cargo within the US or any country, it's usually done by railroad. Transporting cargo from Africa to the US by plane is too expensive since you cannot fit that much product on a plane. Shipping by vessels is the only viable option. When the number of ships in the market falls, then the remaining ships are able to charge more per delivery. When a shipping company makes a lot of money, they usually buy more ships to scale. When the number of ships in the market gets too high again, the shipping companies are unable to demand higher prices, and they lose money. This vicious cycle seems to happen quite often in the shipping industry, more so than other industries. Another thing to consider is the price of steel. When steel prices are high, shipping companies are more likely to scrap old ships. When steel prices are low, shipping companies are more likely to buy new ships. You want to buy stock in shipping companies when there are less ships in the market, and you want to sell your shipping stocks when the market has too many ships. The company is headquartered in Greece and was founded in 2006. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 2.4 billion market cap. They're trading at $23 a share and they have 102 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 18 and 19, but things have improved a lot in 2020 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was negative in 2019, positive in the other years, the highest ever in the trailing 12 months at 211 million. Revenue is the sales for the company, and that's been pretty volatile. It went up from 18 to 19, then it went down, then it went back up. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in the trailing 12 months. And it looks like their margins are really solid. Their revenue was just 70 million higher from 2019 compared to the trailing 12 months, but their gross profit grew by 200 million. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that grew 4 times from 2020 to the trailing 12 months. It doubled from 2018 to the trailing 12 months. They spent 49 million for interest on their debt, which was the lowest amount they spent in the past few years. It was over 80 million in 2019. Then you have other income and expenses. These are all the gains or losses that are not part of the company's core operations. Below that is their pre-tax income, then their taxes. In 2018, they had 45,000 of earnings from equity interest. These are their earnings from their investments in other companies. And the bottom line of the income statement is their net income, which is positive every year except 2019. They had nearly $80 million of operating income in 2019, but they paid so much interest on their debt, over $80 million, that dragged down their net income. So you can see how interest payments can be a real drain on your bottom line. This is the company's latest income statement. This shows us the trailing 9 months for 2020 and 2021, the third quarter of 2020 and the third quarter of 2021. They had their highest revenue ever in the third quarter of 2021, more than double from the same time period last year. The CEO said they had a record third quarter in terms of net income and revenue. Their time charter equivalent rates for Capesize and Newcastlemax was $32,000 per day. Post Panamax, Kamsarmax, and Panamax vessels is $31,000. Ultramax and Supramax is $28,000. I'll show you their dividends later. They paid their highest dividend ever in the third quarter because revenues were so high. You can see how much their daily TCE improved. In the first 9 months of 2021, it went from $27,000 to $32,000. And this $32,000 is part of the $27,000 because the first 9 months is January 1st to 9/30. This number is just 7/1 to 9/30. An increase from $22,000 to $31,000 and an increase from $20,000 to $28,000. Their gross profit in the third quarter was $290 million. Their revenue was $416 million. That's a gross margin of 70%. That's an unbelievable margin. It's good to compare these numbers to similar companies. The average company had a 43% margin and the median was 45%. This is out of 34 companies in their industry. Here's a breakdown of their expenses. $61 million for voyage expenses. This includes the fuel for the ship, also the cost of labor. $54 million for vessel operating expenses. This includes maintenance of the ship, also insurance. Dry docking expenses is $5.1 million. Because these vessels are huge, you can't just leave them in the middle of the ocean. You have to find a place to dock them. $39 million of depreciation. When they buy a vessel, they carry it on their balance sheet and then depreciate it over its useful life. $5 million of management fees. $13 million of G&A. Look how much they improved from last year. $43 million operating income, way up to $235 million. Their revenue pretty much doubled, but their operating income went up 5 times. So their margins improved dramatically. They spent $14 million of interest on their debt and financing costs. This is down from $16 million. Their net income went up 10x from $23 million to $220 million. I don't know if you've ever noticed, but as you get lower on the income statement, the growth gets more exaggerated. The top of the income statement is revenue, and that pretty much doubled. Operating income went up 5x. Net income went up 10x. And their net profit margin was an amazing 53%. The median in the industry is 4%. The average is negative 5%. So you can see how well this company is doing compared to its peers. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that was the highest ever of $335 million in the trailing 12 months. Double from 2020. And they spend a lot on CapEx because when they buy a vessel, the cost of that vessel goes into CapEx and then it's capitalized onto the balance sheet. Operating cash flow minus CapEx gives you your free cash flow. They invested a lot in CapEx in 18 and 19. That's why they had negative free cash flow. But it looks like the investment has paid off and now they're generating healthy free cash flow. They added $110 million of debt in 2018 and $140 million in 2019. But they are reducing their debt load a little bit. They reduced it $21 million in 2020 and $32 million in the trailing 12 months. They added $702 million of debt in the trailing 12 months and they paid down $734 million. That's why I say they paid down $32 million. It's the difference between these two numbers. They've also been buying back a little stock. They bought back $3 million in 2018, $21 million in 2019. These financials are as of 9/30/2021. 3 months ago in October, they purchased 466,000 shares of common stock. They paid a high dividend in the third quarter, their highest ever, but they still had more cash left over, so they bought back some common stock. That common stock purchase was equivalent to $10 million. So when a company buys common stock, It reduces the shares outstanding. It makes your shares more valuable because now you have a bigger piece of the pie. Let's look at the capital structure. 1.9 billion of equity, 1.6 billion of debt. They're 54% equity, 46% debt. And I gave them the highest whack on Finbox, 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 2.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 billion. We divide that by 100 million shares. And we get a calculated stock price of $20. They're trading at $23, so they're trading at an 18% premium. It's a sell according to the model. Their revenue is projected to decrease 8%, so I decreased their revenue 8% for the next few years. That's how I got their future revenue estimates. The average company of their industry converts 24% of their revenue into free cash flow. So I multiplied their future revenue estimates by 24%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $76. So they're way different than me. They're saying the stock is 70% undervalued. 2 analysts priced this stock, one at 35, another at 39. This is where the stock has been trading the last 2 years. So you can see it was below $10 for quite a while. And then when it broke through $10, it really shot up past 25. And you can see there's lots of trading activity. Look how big these bars are. The higher the bar, the more shares that are traded that day. When there's a red bar, that means the sell orders are higher than the buy orders, and the stock price goes down. When there's a green bar, that means the buy orders are higher than the sell orders, and the stock price goes up. So if you see a green bar, that means it opened over here around $21, and it closed up here around $23.50. If it's a red bar, that means it opened up here around 25 and closed down here around 23. When there's a wick, whether it's on the top or bottom, that means the stock traded outside of the open and close price. So you can see it opened here this day and it closed here. But intraday, the stock got over $25. A way to try to value this company is to track the Baltic Dry Index. This index tracks the shipping rates on 20 different dry bulk routes. This is a common index used within this industry. And the reason they made so much money, you can see how high the rates got. At the end of 2021, it broke through $5,500 a day. It has come down a lot since the top, but it's still trading a lot higher than it was in 2018, 19, and 20. I think this may be the resistance point and it should shoot up again. Because if anything, I see demand going up, not going down. There's been a bottleneck in the supply chain. There's much more demand by companies than supply. They have a beta of 1, so the stock moves with the market. It's not too volatile. That's surprising. I thought they would have a high beta. The stock has gone up 108% in the past 52 weeks, much better than S&P, up 24%. The 52-week low is 10, the high is 26. The stock is on an uptrend, trading above its 50-day and 200-day moving average. Over 2 million shares are traded each day on this stock. Of the 102 million shares outstanding, 65 million are on float. 60% of the shares are held by institutions and over 4% of the shares on float or shorted. They paid their highest dividend ever of $1.25. That's a 22% dividend yield. That's the forward dividend. That's assuming they pay $1.25 every quarter. If the next few quarters are blockbuster quarters like the third quarter of 2021, then they will pay this $1.25. But it's likely they're going to bring their dividend down to about 50-60 cents. And their dividend over free cash flow is 259%. Because once again, this is the forward dividend, assuming they pay $1.25 per quarter, which they did not. They were paying 5 cents, then they increased it to 30 cents, then to 70 cents, then to $1.25. The dividend is based off of how profitable the company is in that quarter. So it could be cut to 0 or it could be really high like $1.25. It just really depends on shipping rates. Their industry pays a high dividend, 11%. They're 22%, so they're much higher. Analysts are projecting them to decrease their dividend, but still at 19% is a high dividend. Their employee count has been increasing little by little each year. They're up to 180 workers. If you invested $10,000 into this company 10 years ago, you'd have $4,000 today. That's a 60% loss. But you can see how cyclical this industry is. If you got the stock down here, you'd be up like 50%. So this could be a great time to get in. This could be the big uptrend. You just don't want to time it wrong, because if you do, you'll never get back to break even. 55% of the shares are held by institutions, 34% by the general public, 6.5% by insiders, and 4% by private companies. Brookfield, the Canadian asset manager, owns 25% of the company, 25 million shares valued at $600 million. Then Fidelity, 8%. An Italian shipping company owns 4%. Then 2 insiders own some stock as well. Let's look at their financial ratios. They have amazing price multiples, a PE of 11. That's stock price over earnings per share. So investors are paying $11 for $1 of earnings. A really good price to sales of 2.6. This is stock price over sales per share. Most companies in this industry have a really good price to book because they're very asset heavy. Those ships are very expensive and it makes their balance sheet look really good. So their price to book is 1.2. That's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. It's the book value of the company. Let's look at their non-current assets. $3 billion of vessels. This is the value of their ships minus depreciation. $2 million of restricted cash and $5.5 million of other. Their return on invested capital is 7%. They can cover their interest payments almost 6 times with their operating income. They have a good ROE at 11%. Their current ratio is 1.8. That's current assets over current liabilities. And their quick ratio is 1.6. That's current assets minus inventory over current liabilities. Let's look at their current assets, $370 million of cash and $175 million of other. Let's look at their current liabilities, $204 million of debt and $96 million of other. They generated $200 million of free cash flow in the trailing 12 months. They have $244 million of working capital. Working capital is current assets minus current liabilities. And if they continue paying $125 in dividend payments, they'll pay over $500 million of dividends. So it's likely they're going to cut their dividend. It's pretty unrealistic to expect a dividend over 20%. But even if they cut it in half to 11-12%, that's still an amazing dividend. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as Star Bulk. They spend a little more than average in CapEx. They're less leveraged than the average company, a 0.9 debt to equity ratio. Anything below 1.5 is considered good. Their dividend yield is on a different planet, 22%. They generate more free cash flow than the average company. They're 4th highest in market cap. As I said earlier, the average company has a really good price to book of 0.9, which is just unbelievable. If the price to book is below 1, that means the company is worth more in liquidation than active. They have a great price to earnings, a great price to free cash flow. Their price to sales is worse than average. Average is 1.4. They generate more revenue than the average company. Their return on assets is less than 0.5% because their net income is so small relative to the size of their assets. And their ROE is really good at 11%. So to summarize, I have them trading at an 18% premium, but most people invest in this company for the dividend. Even if you do buy the stock and it's overvalued, if you're able to get a 20% dividend, then it's well worth it. At a time like this, to get a 20% return on investment is just amazing. Of course, if shipping rates decline a lot, the stock price could come down and the dividend may get cut. But if you don't sell, you don't lose anything and you keep collecting that dividend payment. So it sounds like a pretty good deal to me. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.